Hi, I'm Midas of Midas Investing. Today we're going to be taking a look at ticker META, Meta Platforms, the company formerly known as Facebook. We've covered this company a couple times on the channel before. It obviously is one of the largest and most well-known social media companies in the world. And through that social media platform, it is also one of the biggest and most important digital advertising companies in the world. In today's video, we'll be going over my projections for their business as well as my overview of the valuation of the stock in analysis for my own portfolio. I do already hold Meta as a company within my own portfolio, full disclosure, and we'll see just how long I may be holding on to it given the value that I assigned to it today. If you enjoy valuation videos like this, please like the video. It's the number one way that you can help us with the YouTube algorithm, and subscribe to the channel if you're not already. Also join the Discord, link to which is in the description below, to become part of our free community where we discuss stocks every day. So to take a quick look at the overall market pricing of Meta, you can see the overall movement of the stock over the last 10 years and the 1-year average moving price along with it. You can see in the last year, we've had such a precipitous drop in the overall price, what with the major slowdowns in growth, which we'll kind of get into relatively soon, and the overall slowdown of the economy as well. Narrowing in on the last 3 years, you can see it a little bit more narrowly focused. The average price for the last year has been $263, $267 or so. So we're still a little bit below that overall price, but it has recovered pretty significantly in the last few months, coming in and narrowing a little bit more on the 3-month average price over the long run, as well as the share count over time. You can see that there has been a little bit of a more acceleration in the buying back of shares for Meta in the last couple years, as well as they recently announced with their fourth quarter earnings another 50 billion authorization for share buybacks. So that'll be good to hopefully see that share count come down. Not to mention with the value that I've signed here today, I would say that's overall a pretty good move. The average price in the last quarter has been $198 per share. So obviously you can see that's significantly lower than the 1-year moving average. Focusing in on a few different metrics, I have the EV to sales ratio over the last 10 years right here, along with, you can see the pretty rapid growth of revenues alongside it. To counteract next to that, we have the net cash as well as the minority interest if it exists for the company. So you can see what else affects the EV to sales ratio. But the EV to sales ratio coming down from up in the 20s and 30s, which is just a ridiculous ratio to have, coming down into kind of reality in the last 5 to 10 years. Last 5 years getting down below 10. In the last 3 years, you can see it's really come down into the single digits pretty significantly or so. The last 3 years, the median EV to sales ratio by month has been about 8, and then the last year it's been about 3.4, which puts it more in line with kind of like the overall market of what you might typically see. Focusing on other ratios, we also have the PE ratio over the last 10 years. You can see I do have EPS as well as my own adjusted EPS, which includes R&D capitalization, which we'll look at with some of the metrics. So I do have two versions of the PE ratio here. I do think the adjusted PE is a more representative of the actual earnings of the company. You can see for the last 3 years, the normal PE has been on average about 25 versus about 20 or so for the adjusted PE. And in the last year, it's been 13 for normal and then 9.5 for the adjusted PE. But definitely, so you can see on an earnings basis, whether it's by GAAP earnings or by adjusted basis, it's definitely come into cheap territory, not just within market territory, which is what we saw with the EV to sales ratio. And then you can focus in on other metrics as well. I have the EV to free cash flow metric, just in case PE isn't necessarily representative for another company. An EV to free cash flow metric might be an alternative to a PE ratio you could look at, and that's a little bit hotter for a higher in general for Meta, because obviously they've had lower cash flows because they've been reinvesting it so much. The last 3 years on average, the median being about 37 to 38, and last year it's been about 21. So that is still also coming down pretty significantly, though literally in the last quarter it jumped up pretty dramatically, because for the last year their free cash flows dropped off a cliff. But even so, the 1-year average still came down, which is interesting to see. Now coming over here to our financial statements page, where you can take a look at the 10 years worth of annual financial statements for the company. You can see I have the revenue backdrop against the share price and the EPS, though you can barely see the EPS there. And you can really just see how the revenue, yes, it came down this year, but really it's really just, you could just say it's leveled off. And even that alone just caused the share price to absolutely crater down comparative to the massive growth it had over the last 10 years. Very, very dramatic downward movement just by the hint of basically no more growth being in existence for the company. But you can obviously come down into the cost and take a look at the gross margins over time. there's been a little bit of a upward movement and then a downward movement in the gross margin. So you could argue that this is definitely starting to trail downward, but it doesn't quite have the same kind of lockstep movements as you see with the downward movement of revenue. So I wouldn't really look at this and be like, oh, the margins are dropping off a cliff in terms of per unit costs in terms of like the last year or so. The thing that I would say has more of a larger effect beyond just the drop in the revenue growth on the overall profitability of the company, and that drop in cash flows that we were just talking about has to do more with the operating costs specifically, which you can see in this graph right here. In the pink line, I have SG&A as a percentage of sales over the last 10 years. And you can see when it dipped down here in 2016 to 2017 through 2018 or so, we had a pretty large bump up in the normal GAAP operating margin, which we have in the orange line right up here at the same time. So with a little bit of the tip up here in the last year or so with SG&A, you can also see the massive drop off in the op margin on that basis in that particular time frame. Not to mention the GAAP operating margin also takes into account R&D, which we have down here in this next graph. You can see the R&D has just grown and grown and grown pretty dramatically. Now, with companies that do R&D, I perform an R&D capitalization process where I take the R&D costs, I put them on the balance sheet, and then I amortize them away at a certain rate based off of the rate of technological growth within their industry. And then I take a look at the net amounts of R&D added each year as effectively new growth for the company, which is what the dark purple is right there. One thing to note is not only is the overall R&D growing dramatically each year, year in, year out for the whole decade, but so is the net R&D. So it's not only are they doing massive amounts of new R&D every year, it's massive amounts of new R&D beyond the amount that would be needed to replace the previous R&D. And then the R&D as a percentage of sales, if you kind of take a look at that in line with what I was saying about 2016, 2017, 2018, you can see that the overall R&D as a percentage of sales had come down during that time frame as well. And you can see that that's really spiked up dramatically within the last year. So that's really where the drop in the operating margins comes from, is from this drop, this massive increase in the R&D as a percentage of sales. However, like I said, I take these into account with my own adjusted numbers. So if we actually take a look, for example, at the adjusted EBIT versus regular EBIT, which we have the yellow and the orange, you can see that in the last year, the regular EBIT that GAAP would assign to it would be about 28.5 billion versus adjusted for R&D capitalization over a 3-year period, which is what I'm doing for Meta. I end up with 43.3 billion of EBIT for them for the year, which changes their overall EPS from $8.59 per share to $14 per share in the last year or so, which is where we get that huge difference in the PE ratios that I was talking about. Though, of course, you can take it or leave it as far as those adjustments go. The point is I actually value massive amounts of R&D being done by a company. Even if a huge amount of it doesn't pay off, I think that it gives them a huge competitive edge comparative to their competition. Now, taking a look at this, as I was saying, if we're going to count R&D as part of their investment in capital, you got to compare that with other investments in capital that they make, like, for example, PP&E, along with acquisitions and intangible assets. Now, if you add the overall net R&D amounts, which is the new R&D that I was talking about with the capitalization process on top of that, then you get the overall reinvestment as a percentage of sales over time, which we have right here, which gets us closer to maybe like 20% over the long run. In the most recent time frame, maybe 20 to 30%. And that is the difference between the adjusted after-tax operating income, which is this kind of orange line here at the top, and the free cash flow, which is the green at the bottom. The difference, the yellow, is the net reinvestment that you have in this graph right here. So you can see the difference between their profitability and their free cash flows and the amount that they have to reinvest in order to get those free cash flows in the future. The other thing I kind of wanted to point out is the overall trends in the returns on invested capital. You can see that the returns on invested capital had a pretty large bump up during that same kind of time frame that we were talking about, where the SG&A sales had come down dramatically and the operating margins had increased. As you can see, that's kind of the same trend going on. The returns are coming down right now. I would argue that that's basically them reinvesting, gearing up for another wave of high returns on invested capital in the future. Coming on here, look at the asset ratios graph that I have here. You can see the current ratios, liquid ratios, quick ratios, a lot of the kind of liquidity-based ratios, all of those have been coming down over time as their overall asset base has grown pretty significantly. They've shifted pretty dramatically from short-term assets towards longer-term assets. You can actually also see that up here with these graphs, the current assets as a percentage of the total assets coming down as overall total assets grow. And the same thing can be said for the current versus total liabilities. But how that plays out in the asset ratios is you can see With these ratios coming down over time, the kind of contrary aspect of that is the asset turnover ratio, which is a little bit of a different ratio, has been coming up over time. This is a capital efficiency measure, sales relative to the overall assets, basically saying how many years worth of sales will we need to replace all the assets. Which, if you understand accounting, you'll know that this ratio, the asset turnover ratio, is very, very close to the sales to capital ratio, the ratio that I like to use for measuring reinvestments of your profits for free cash flows in the future. So the fact that we can see this growth in the asset turnover ratio, despite the kind of large volatility and variability in the returns on invested capital, I think gives us a good indication that these large reinvestments in R&D as well as in PP&E may actually pan out well in the future. It seems that they've shown this trajectory in the past. Switching gears a little bit, I opened up my industry data set spreadsheet as I have right here. We're definitely thinking of Meta as part of the software entertainment industry. It's the part of industry that they're part of here. Adjusted unlevered beta of 1.46, normal beta of 1.36, versus the adjusted operating margins on average for the last 8 years has been about 24%. Versus the last year, it's been about 30%. Again, that's compared to adjusted operating margins for Meta of over 50% or about 50% for the last 10 years or so, relative to the relatively small profitability they had in the most recent year comparative to that. And then the sales capital ratio, as we were kind of talking about, we saw that the sales capital ratio, the asset turnover ratio, was getting close to 0.75. You can see that for the industry itself, it used to be a little bit higher in the past. It's actually been kind of somewhat coming down for the last 5 and 3 year averages, and then the last year was a little bit higher than that. Returns on invested capital for the industry like 15. So at Meta, you can kind of see that they have pretty high operating margins relative to their industry. They have sales capital ratio or their asset turnover that's maybe not quite as good as their industry, but their operating margins increase relative to their industry seems to counteract that enough to give them much higher returns on invested capital than their industry. This is the model that I built up for my revenue projections for the company. And as we look at this model, you'll notice that it's actually built up entirely from Facebook revenues, and Facebook revenues built out from the family of apps. We're not really including anything from Oculus or also in particular from the projected metaverse. My reasoning for doing that is that metaverse is a future expected business. It's more like a conceptual technology that I'm thinking of more as an application that is going to sustain the growth of Facebook and the family of apps itself, because I can't really attach a specific revenue projections to the metaverse because there isn't really a business model attached to it. There's just a lot of costs associated with it. And so I'm effectively just going to assume that those costs are kind of like excess R&D, rather than like the rest of my R&D that I amortize way off the balance sheet is just going to be treated as a one-off that's being written off immediately. We have the last 10 years right here with the last 10 years of revenues displayed right here. You can see between 2013 and 2022, it was a compounded rate of growth of about 35% per year, versus the last 5 years has been about 20% rate of growth. So that's about 58% of the growth rate of the overall 10-year period versus the last 5 years. So you can kind of see the step down in growth in the last 5 years versus the 10 years. And we're going to kind of use this pattern of comparing the 10-year growth versus the 5-year growth and the ratio between the two for a few of these key metrics. I also have daily active users for Facebook. This is Facebook specifically within Meta, and then the monthly active users for that, and then the ratio between daily and the monthly active users over those same timeframes, as well as the average revenue per user for Facebook specifically within that time frame. So you can see the daily active users grew at an 11% CAGR over the 10-year time frame, and then at a 7% CAGR for the last 5 years or so, showing a 62% ratio between the two. The monthly active users, it went from a 10% over the 10-year time frame to a 6% growth, showing a 61% ratio between the two. And then the ratio overall between the daily active users and the monthly active users, this actually still did climb very, very slightly over the time frame, going from 62% in 2013 up to 67% in 2022, which is about a 1% rate of growth over the 10-year time frame, and still ends up being about a 1% rate of growth. It comes down to a fraction of that, but I'm not really showing the decimal places here. But either way, the ratio still ends up being about a 69% ratio between the 10-year growth and the 5-year growth. One thing, and then also we have ARPU doing kind of a similar trend between the 10-year growth of 20% CAGR and then 10% growth for the last 5 years. That ends up being a ratio of 51%. Pretty interesting to see that these ratios between the 5 and 10 year timeframes are pretty consistently kind of in this kind of middling territory, about halving or maybe 2/3ing. The average overall between them ends up being 60. I took this kind of a basic average between the two, and we're going to kind of use this number as kind of a guidelines for thinking about how the growth is going to slow down in the company. It's a relatively simplistic, rudimentary, blunt way of kind of thinking about it, but either way, I think it does a good job of painting the picture, and you'll see how we're going to use that a little bit here in the future. So that's Facebook specifically within Meta. Obviously, there's the rest of Facebook to take into account, Instagram, WhatsApp, as well as there is the rest of the company as well. It's worth noting this revenue model, I'm basically building it up off of Facebook revenues. How I'm going to be doing this is we're going to be thinking about the Facebook users and trying to figure out how many Facebook users we're going to have in the future based off of the family users, which includes those other applications. And what we're going to do is we're going to try to think about growth of the family base, and then what percentage of that is going to switch into the Facebook base. So now taking a look at our information for the overall Meta family of apps, daily active users has grown for the last 5 years up at about a 10% clip, monthly active users at about a 9% clip, the ratio between the two at about a 1% clip, and then the ARPU at about a 7%. Now taking a little bit of a closer look between the two groupings, between Facebook inside of the overall Meta grouping and then the family, what about the ratios between Facebook to family? Now, the monthly active users, we can see that the overall ratio between the monthly active users of Facebook to family went from 88% down to 79%. So basically what that means is that back in 2018, there was a larger section of the overall total user base of the entire family of apps that was within Facebook. And now there's a larger amount of the percentage of total family users that are not part of Facebook. And keep in mind, that's all while the entire user base was growing dramatically. So that means that there's now a larger pool of users that Meta has that are not part of Facebook specifically. And that's all the while both of those platforms were still growing in total user bases. The ARPU, what about the ratio of ARPU between Facebook and family? You can see the ARPU for Facebook versus family of apps is significantly higher. And that makes sense because most of the advertising dollars comes from Facebook specifically. So you would expect the vast majority of the revenue to be coming from Facebook. So obviously the ratio should be higher. Now, what's interesting here is you can see that ratio has climbed actually a bit over time at about a 3% clip for the last 5 years. So what that shows is that Facebook has become even more profitable relative to the overall family of apps profitability, which makes sense. So what we see between those metrics is that effectively speaking, what Meta has done over the last 5 to 10 years, and especially in the last 5 years, we can argue about whether or not it's going to happen in the future, but this is definitely how the past looks to me, is that the concept is about trying to essentially shove people into the overall family of apps through whatever means they can, recognizing that those the overall family of apps isn't going to be that profitable, and then they're going to try to funnel as many users through the family of apps into Facebook profiles, to which then they can target with ads and get a relatively high ARPU out of them. This does break down a little bit and get a little more complicated when you do things by different geographies, and I chose not to do that with this model. I chose to just think broadly about Facebook versus family versus the kind of conversion between the two, and not really break it down by specific geographies. You could have chosen to do that if you want to, and they certainly provided the information if you wanted to, but I wanted to keep it somewhat simple, not make this too complicated. Now down here, I also included a line showing the overall world population and what percentage of the family of apps monthly active users is of the world population. I wanted to know is like just what kind of penetration of the entire world population has these family of apps made, because the family of apps is very much more like communication devices, more like WhatsApp and Instagram. It can be very much like short-term, relatively simple communication without much actual interaction necessarily, and any much commercializing, which is why the ARPU doesn't grow there. Whereas there's a lot more connection, a lot more interaction, a lot more commercializing happening on Facebook. And so between that, the question is okay, well, what kind of overall user base of the world population have they gotten that they can then convert into potential customers in the future? The overall amount of the world population that was in the monthly active users of the family apps was 35% back in 2018, and it's grown over time up to about 46% here in 2022. So that's a pretty huge growth of the overall world population they've gotten. They already had 1/3 of the entire world as part of their monthly active user base, and they grew it to less than half, but getting close to 1/2. And now that's a great thing for those 5 years, but then that leads us to the next question of, well, how much further can they really go? How much further can they really push that into the future, which we'll get into here in a second. All right, so what I chose to do here is that in order to build up to the revenues, I needed to come up with the monthly active users for Facebook, as well as an ARPU projection for Facebook in both my worst and best case scenarios. And the way I'm going to build it to the monthly active users for Facebook is by projecting against the monthly active users for the family at a certain ratio, which I'm using 61% as the ratio. I get 61% as a ratio by comparing the ratio between Facebook and family monthly active users and seeing where I think that's going to come to over time. Now, we saw that the ratio is currently at 79% and it had shrank at 3% per year for the last 10 years. And so I'm choosing in my worst case scenario to assume that it continues to shrink at 3% per year for the next 10 years as well. That gets me to this 61%. And that 61% is multiplied by this 2.3 billion or so, which I get to 2.3 billion after multiplying by the 61%, which comes from 3.7 billion of which is effectively just assuming that the monthly active users for the family is not going to grow at all over the next 10 years. Now that's, like I said, my worst case scenario. My worst case scenario is assuming that the family monthly active users does not grow over the next 10 years. Now, I don't actually think it will not grow. I think it, in a worst case scenario, could maybe grow and then shrink again. That's probably more likely what would happen in this scenario. But the point is, worst case scenario, we'll just assume family monthly active users does not grow, and instead it comes down to just a conversion between how the family to the Facebook from which the revenues would come from. Then, in order to build up to the monthly ARPU in that worst case scenario, I am multiplying the current ARPU of $10.86 per share by 3% per year, which I get to by multiplying the 60% ratio, which is the average kind of downward movement of growth that we saw over time ratio. And I'm effectively saying, well, what if it was twice as bad as that? What if instead the ratio was 30%, which then brings essentially the 10% growth that we had for the last 5 years down to possibly 3%. It's a relatively blunt estimate, basically just slowing down the growth at a nice smooth rate, but it gets me to ARPU of just under $15 per quarter per user for that scenario. And between those two numbers, that builds me up to a worst case scenario revenue of just under 135 billion per year at the end of 2032. Now, I did the same thing in for my best case scenario with a building up to 3.9 billion monthly active users, which is 79% ratio of 4.9 billion monthly active users for the family. I get up to this number right here by instead assuming that they're going to grow at about 3%, which is a 30% decline from the 9%. So I'm kind of using the same thing where I'm taking the 60% ratio and cutting it in half, just assuming that over a 10-year period, it's going to slow down the rate of growth pretty dramatically. So I'm choosing 3%. It's a pretty arbitrary growth rate, but it gets me to 4.9 billion monthly active users for the family. And then a 79% ratio of that, which I get using the 79% ratio because that is the most recent ratio between the family and the Facebook monthly active users. In our worst case scenario, we had assumed that ratio would decline by 3% per year. In our best case scenario, we'll just assume that they managed to hold the line where they're at right here. Keeping in mind again that they had declined 3% per year for the last 5 years in our historic history we already saw. So if I multiply that 79% by that gets me 3.9 billion monthly active users. And then I have to have an ARPU for my best case scenario as well, which I get to that by multiplying the rate of growth that we had for the last 5 years by 60%, which is effectively just assuming we're going to have the same decline of ratio rather than assuming that it accelerates the decline, which is what we did in our worst case scenario. So worst case scenario, 3% for that, best case scenario, 6% for that. That gets me to an ARPU per quarter per user of $19.70 per share. Which builds up to a revenue of 306, 307, or 305, 306 billion. Man, I can't read numbers sometimes. And with that, we can come over to take a look at the various quartiles of our outcomes. Here is the revenue cases as I was talking about between the bull and bear case. You can see the bull case comes up to about 290, 291 billion, bear case at 136 billion. So a little bit different from the numbers we saw in the revenue models, but approximately in that ballpark, getting us this kind of range of overall cumulative growth over the 10 years. And these are the year by year growth assumptions within those outcomes itself. Getting us to a 10-year growth CAGR in a bull case of just under 10% per year, in a bear case just under 2% per year, the base case being about 6.5% or so. Coming down, you can see the operating margin assumptions. Now, I kept my operating margin assumptions relatively simplistic. We had adjusted operating margins on average of 50% over the last 10 years, and I'm basically assuming that they're going to stay on average about 50% for much of the first 5 years, and then I believe over the 10-year time frame, it ends up averaging about 45%, and then it declines towards an average of about 35% in the terminal year or so. That gets us operating income quartiles, as you can see right here. The third quartile of operating income is about $97 billion in 2032 versus the first quartile of about $65 billion. So that's operating income growth over in the third quartile of 7% per year for the next 10 years versus the first quartile of about 3% per year. Keeping in mind, when I say between first and third quartiles, that implies 50% of the potential outcomes would occur between those 2 points. Scrolling down, we can also take a look at the returns on invested capital under those same assumptions based off of these amounts of capital investment from that operating margins. So you can see the reinvestment levels are between like 10 billion per year to 20 billion per year, depending on the time frame, and that's coming off of that 65 to 90 billion or whatever operating margins, which gets us down to free cash flow numbers, as you can see right here. The free cash flows being between the third quartile of maybe $59 billion and the first quartile of about $39 billion or so. So returns on invested capital on average in the median case, or not on average, in the median case for the next 10 years of about 24-25%. And that gets us to our free cash flow distribution, as you can see right here, with a lot of the kind of outcomes kind of leaning towards the lower end of it, but with some potentiality for pretty high-sided of free cash flows. Our median case, 47 billion, here in the middle with the highest amount of potential outcomes. And here's the relatively simple financial depiction of the base case, the expected case across all of these outcomes. As I was saying, you can see the expected revenues per year over the 10-year time frame, the average operating margins being about 44.5%, with the effective tax rate climbing up towards a terminal tax rate of 25%, invested capital being about $300 billion in the terminal year versus the expected revenues of about 219 billion or so. Expected free cash flow is 49 billion. Average cost of capital over the 10-year time frame of about 10.3%. Again, coming down from that relatively high cost of capital that we had at the start of closer to 12%, based off the assumptions I had implied. And as I had showed, terminal growth of about 1.5%. That gets us to current fair value of $203.89 per share, upside of about 14%, and a 10-year expected CAGR based off of the cost of equity assumptions that I have implied of about 12% per year. Within the value distribution, that puts them at about 38 percentile. So not quite twice as many of outcomes to the upside versus the downside, but pretty close to that point or so. And you can see the fair value distribution right here. So we're currently maybe about here or so within, or is it 79, 179? We're about here within the distribution. My fair value is about here. And here's the same distribution for the expected returns. The third quartile price being about $229 versus the first quartile of $170 or so within that outcomes right there. So if you did buy at maybe $169, then there would be 3 times as many outcomes to the upside as there is to the downside, assuming these assumptions hold. If you've enjoyed this valuation, please like the video. It'll really help me with the YouTube algorithm. Also subscribe to the channel, that way you get notifications the next time I put out a valuation video. Consider joining the Discord. The link to the free Discord is in the description below. Join to be part of the daily discussions we have of what's going on in our portfolios, as well as what's going on in the market. So that's going to do it for my analysis of Meta Platforms and my evaluation of the stock in consideration for my own portfolio. As I said, it is already a holding of mine, and we're here mostly trying to decide exactly what we want to do moving forward into the future. Based off the assumptions here, I definitely think we'll be holding on to it for a little bit more room to grow. We'll see how that plays out for us moving forward. All right, I'll catch you all again next time. Bye.